Okay, it looks lateral, but the trend was actually down based on how I define trend, and that is proprietary for the software. Now, just because you know it's a morning star, that's only part of the challenge. Now you have the candlestick signal. What do you do with it? Do you buy with it? The answer in this case is no, because of the poor risk reward. So just because if you use a scanning software or you do it on your own, you have a candlestick signal, use that as your first step. The second step is analyze if the risk reward is attractive. In this case, it wouldn't have been. Yes? Yes. Yeah. He's saying, just to be clear, isn't that followed by an evening star? And the answer is yes. Exactly. Now, if you view that as an evening star, which I would, why would you not sell short on that evening star? It's still at a support level, right? I'd wait for it to close under the evening star, and as soon as it closed, actually, it closed under the morning star. As soon as it closed under the morning star, that to me was quite negative, because not only did it close under the morning star, wasn't that morning star confirming a support level? Right? So I would be perfectly comfortable being short there. That's a momentum play, right? We have the morning star. At least that keeps us in from going in from the short side. Where do we go short if we see a morning star? Let it break the support area of the morning star. Okay, let's think about this risk reward. Okay, what do you think? How many like it?
Excellent.
Yeah, I think it looks great. Yep. I think it looks really good. The hammer of support and resistance, I would say, once again, a little hard to see. This is the dollar Canadian, around 125. One of the things we'll look at later is prior support can become resistance. So we may have had a support area over here. So that would be my first potential resistance. I would call this R1. But the much more important resistance would be up here at R2, at that second red line. But even if you view R1 as a conservative, what I'll do sometimes is have a conservative and a more liberal target. Even if you viewed R1 as a conservative target, I think this risk reward looks fine. And if your question, then go ahead.
You won't enter at that hammer, right? Because all the next candles, some of them goes below the hammer.
Okay, none of the candle signals after the hammer closed under the hammer. They moved under the hammer, but they didn't close under it. I don't think so. I don't think any can.
To the right.
Oh, yeah, I see.
Okay. It didn't close under the hammer. It moved under it, but it didn't close under the hammer. And in fact, if you were a little bit more nervous about buying in the hammer, which is perfectly fine, because although it's a hammer, is it a new low close for the move on that hammer? Isn't that a new low close for that move? Right? So we'd say to ourselves, okay, maybe we'll buy on the hammer, but nothing says we have to be fully in the position. 25, 50%. And then as the market is building a base there, we could add to the position. I like it when the market expands on the base. Okay, the Japanese say ice 3 feet deep doesn't form in one day. And something like this is absolutely great because you're expanding on the base. And when that happens, once the market goes, it could really get going. And what's nice also about expanding on the base, you have a very important support area. So for momentum players, if we're expanding on the base here and the market closes under the hammer's low, that's the time to go short. For those who are playing the candles as reversals, as long as the hammer holds the support and expanding on the base there, I would be adding to long positions. Okay, the if-then system. We're spelling out discipline. Again, it may not be in order. The first two we happen to be DI, but we're doing that, but they're not all going to be in order. If-then. That means if the market does such and such, then we react accordingly, if-then. So if the market breaks support, then we think about selling short, like the prior slide, right? If the market breaks resistance, then we could think about going long. If the market stalls at resistance, then we could think about selling short. One of the major mistakes many traders do is anticipate So let's say we have a very important support area, and the market is holding support, but there's no bullish candlestick signals yet. Some people may say, hey, I'm going to be buying on the support, thinking it's going to hold, but we really have no confirmation. And very often in that case, if there's no turning signals with the candles, the markets will break support. Once again, it becomes a trade-off between profit potential and risk. Let's say the market, let's do it the other side. Let's say the market's moving up and it's getting to a resistance area, and you're thinking it's going to break through the resistance area. You don't know until it's done that it's going to break through resistance. The market's at resistance, no signs yet of either, let's say the bearish candlestick signals. The market's, let me backstep here. Let's say the market's at getting to a resistance area. It's moving up. Now, do we know if it's going to break support or, in this case, resistance? Do we know the market's going to break resistance? No. Let's say you feel it's going to break resistance. So you're going long before it breaks the resistance area. If you're right, you have more profit potential, correct? But what about the odds of the trade working? Less. Of course, the market has not yet broken the resistance. If we wait for the market to break resistance, the odds of the trade working are much higher. We do have less profit potential. I prefer the latter scenario. I'd rather have the market break resistance to let the market tell me the bulls are really in control. So the way I would look at it, if the market breaks resistance, then we can go long. Okay. If it breaks support, we can think about selling. This is really what momentum trading is all about. Okay, here we have a hammer and a bullish engulfing pattern. How about from a risk-reward perspective? What do you think? Looks great. Looks excellent. Looks fine. Okay. If you do a trade and it doesn't work out within a certain amount of time, then get out. It's called a time. We're going to look a little bit at stops later on. I talk a lot more about stops in my advanced DVD, but we'll talk a little about it today. It's called a time stop. You don't want to commit capital to a trade that's not working out. So here we have the bullish engulfing pattern, and it's just meandering. This is an intraday chart, but I don't know if it's days or whatever this period is. But this is a trade I would not want to stay in. The general idea with the if-then also, if you do a trade and it doesn't work out, then get out. Whether that means a time stop if it doesn't work out within a certain amount of time, or if you're buying, let's say you're buying on the bullish engulfing pattern, and then you're looking for a particular target, and it gets maybe within a few ticks of it and then starts pulling back. Keep in mind, a support and resistance area are not exact. A lot of people forget about that. So even if you get to within a few ticks of support or resistance, you could think about getting out of the position. But the general precept, if the market does something, then we react according to what the market is telling us. What's that?